I'm Shane Simser, Senior Financial Advisor and Business Manager for Morgia Retirement Plan Services. I have 15 years of experience helping people like you understand your company's retirement plan, save into the plan, and preparing for your retirement. Before we get started, let's talk a little bit about Morgia Retirement and who we are. Morgia Retirement is a locally owned wealth management and retirement services firm in Watertown, New York. We manage over 40 401k plans locally. We have a team of 13 team members who are dedicated and focused on helping you reach your retirement goals. You've decided to save into your plan. You're possibly receiving the employer match, and you understand the tax benefits. Now you must decide how to invest your savings or decide on what investment model or individual investments fit your risk tolerance and time horizon. When deciding on how to invest your savings, you must look at a few things. What is the mix of assets that I should have? We call that asset allocation, the process used to balance your risk versus your reward. You must decide how much to invest in cash, bonds, and stock. And to make that decision correctly, you need to understand the types of risk associated with each asset class. Choosing the right level of risk, or asset allocation, is far more important than the selection of the actual investments. We as advisors will help you determine what is the right asset allocation for you. We'll ask you a series of questions. What is your risk tolerance? How long do you have to save? How long do you have before you retire? Where are you at in your working career? We can help you determine what investment model best suits your needs. Understanding the different risks with each asset class, we look at cash first. Cash is simple and straightforward. It is cash sitting in a money market account. There's not a lot of risk to principal. It's a great vehicle to use to help fund short-term investment goals or short-term purchases. There's not a lot of potential growth with cash. The risk with keeping money in cash is that over long periods of time, it does not help you increase your spending power. If anything, it can decrease your spending power as inflation occurs or rises over the years. Let's look at bonds. Bonds provide a higher rate of return than cash, but you commit your investment for a longer period of time. At the end of the time period, you get your principal back. It's like loaning your money to a corporation or the government for a period of time. They will pay you some interest, and at the end, you'll get your money back. But there are two risks associated with buying bonds or owning bonds. If you need your cash prior to maturity, you may have to sell the investment for less than what you invested. The interest rate that you lock in turns out to be less than actual inflation during the life of the investment, and you lose purchasing power on the money invested. Now let's look at stocks. Think of stocks as direct ownership in companies traded on a public stock exchange. Think of owning stock or shares of companies that you know and you use their products every day. Over long periods of time, the price of a stock will grow at a rate that reflects the company's ability to earn profits. Over a long time frame, you can expect a higher rate of return than cash or bonds. However, there is no guarantee on these returns. Stock markets are not always rational. The risk with stocks is that in a given short period of time, they can lose substantial value. So take your time when deciding on your asset allocation mix and make sure you understand the risks and rewards associated with each asset class. And remember, the most important decision is to start saving.